Hey everybody, this is Joe Harris from Morgan Financial, and I'm here with
Jake Honadel from Morgan Financial.
Awesome. Jake, what are we talking about today?
So today, I think this is going to be a great talk. We're going to be discussing the main factors that determine the interest rate when you're financing. Obviously, that's a huge point of discussion right now. So I'd like to just jump right into it.
All right, let's do it.
So the very first one that we're going to be discussing is credit score.
Okay.
So really, how does your credit score determine the interest rate? What does that look like?
Credit score is a very important factor in determining your interest rate. So credit scores show the borrower's ability and willingness to pay back their loans on time as promised. Okay. So everything that we're going to talk about, all these factors are all risk-based. All right. So the higher the risk to the lender, for the risk is default, right? The worst thing that can happen to a lender is someone doesn't pay their mortgage.
Yeah.
And so all these things we're going to talk about go to more risk, okay? Or more or less risk.
Yeah.
The higher credit score you have, it's not the only determinant, right? But the higher credit score you have, the less risk of default because you've proven you can pay your bills. Does that make sense?
Yeah, definitely. And, with that credit score, obviously, if somebody does have a really low score, why would a bank look at maybe a low score and see that person as very risky?
Well, because they have a history of not paying their bills on time or defaulting on loans or bankruptcies or foreclosures or other things that might make that score. So it's not just the score.
Yeah.
It's also what's driving the score. But the score does have an impact on your price. So the lower the credit score, you're going to have more pricing adjustments than you would at a higher credit score.
Yeah.
But it's one of the factors that we're going to talk about today. And it's probably the biggest factor involved.
Yeah, definitely. And, obviously another factor that a lot of people, tend to, consider is that down payment.
Right.
How much can you put down? What does that look like? I know that can obviously affect the rate as well. How does that affect the rate?
So great question. Again, risk. The more you put down, the less risky the loan is to the lender, right? So if you default, you stop making your payments, but you put down 50%, half the home's value when you went to purchase it, there's a lot less risk to the lender because they can recoup their cost of foreclosure easily from the borrower. And also, you're less likely to walk away from a home, or in other words, throw the keys back at the lender, so to speak, if you put a lot of money down. If you put no money down, you have nothing really to lose to walk away from, technically, other than bad credit and some potential lawsuits and things like that. But the more you put down, the less likely you're going to be to walk away from your equity. The higher the down payment, which goes to something that you might have heard of called loan to value. And that loan to value is how much you're borrowing versus the home's worth, right? And the higher loan to value means you put less money down. Your rate is not going to be as good as if you put a whole bunch of money down. Yeah,
and that makes sense. And it kind of makes me think of the obviously the skin in the game that you have. If you put 3% down, then you don't necessarily have as much invested as, like you said, if you put half the amount of the home down, then obviously you're going to have that investment. You've put in that equity into the house. So that makes a lot of sense.
And so again, goes back to risk to the lender. The lender's risk is lowered. You're less likely to default if you have a higher credit score. You're less likely to default if you put more money down because you don't want to walk away from that equity.
Yeah, for sure. And obviously the next thing is the terms of the mortgage. Obviously you've got 30 years, 15 years, probably things even within that spectrum.
Correct.
How does just the terms of which you get the mortgage, how does that affect the rate?
Okay. Well, obviously the longer you have the money out for, that's a bigger risk to the investor, right? 30-year loan has a bigger risk than a 10-year loan. Okay. And on a 30-year loan, you're paying a lot more interest up front. So 30-year loans will cost the borrower more money over time, but also gives the borrower flexibility to have a lower payment than, say, a 10 or 15-year term. So the terms typically in a typical market, a 15-year loan term is typically going to have a better interest rate than a 30-year, everything else being equal. Now, there are times when we have those that are very close, like right now, the 10 and the 15 and the 30 are very close. And sometimes there's a very wide spread between the two. So typically there's a better interest rate on a shorter term than in a longer term. Yeah,
that's interesting. And so if you're willing to be able to pay a little bit more money for that shorter term, you're going to get a better rate.
Sure.
But it's a little bit more favorable with that 30-year because the payment's going to be lower and it's probably more manageable.
The payment will be lower, but on a 30-year, you're going to pay a lot more interest than you would on a 15-year loan.
Yeah.
But that 30-year does make the houses more affordable to many, many people out there.
Yeah, definitely. And, obviously another thing that we get all all the time, people talking about is the debt to income ratio. What do your bills look like? How does that play into the rate, or does it play into the rate? What does that look like?
It does now. So debt to income didn't used to have an impact on Fannie Mae and Freddie Mac loans, but there's new provisions that say that the debt to income will have an impact on their rates, and it makes sense. If your debt to income is higher, that means the amount of money you have going out is closer to the amount of money you have coming in. So in other words, the money you spend on your monthly debt obligations like credit card bills, car payments, student loans, things like that, versus your income, that ratio, the higher that ratio is, there is going to be a pricing adjustment if it's over a certain amount to the borrower. So it's going to have a slightly higher interest rate if you have a higher debt to income ratio.
Well, that makes sense too, because if you have a ton of bills and that high debt to income ratio, you are going to be more of a risk, And Correct. So like you said, this kind of all comes back to the risk that the bank is taking and lending you the money,
Bank, lender, Fannie Mae, Freddie Mac, you, me, right?
Exactly, yeah.
So yeah, it is the risk-based pricing.
Yeah, that's crazy. And so obviously property type, that plays into things as well. And obviously there's, several different types of property. What does that play into, the interest rate when they're making that determination?
Well, great question. So a property type would be if it's a single family residence, detached single family home, right? Or a condo. Or a multi-unit property, a 4-unit property. Mm-hmm. So let me take the example of a condominium, right? So condominiums, if you're going to buy into a condominium, your success or failure is paying everyone around you. Yeah. Okay. So because if everyone around you stops paying their condominium association fees, your COA, or a HOA in the terms of a neighborhood. So if you're in a condominium association, you're tied. Your success or failure is tied to everyone around you. And what I mean by that is everyone stopped paying their fees and dues. Well, that's going to pile up, and either the property is going to become decrepit and unmaintained, or it's going to be pushed more of a cost onto you. Mm-hmm. So that's why they're scrutinized more condos. But not to get into the condo discussion, as far as the interest rates go, yes, condominiums are going to have slightly higher interest rates than a regular detached single family home because of that. Because you're susceptible to all those around you, and a good association, a bad association might not pay their insurance, and that might lapse. There's a lot of things that could go on, right? It's just more risk versus that person has a single family detached home. They have insurance. They have pay their taxes. It's one unit. Mm-hmm. So the condos do have a slightly higher interest rate associated with them.
Yeah. And so I think that these things that you've discussed are so important because it kind of tells why the rates are what they are. And I think that might even take a little bit of the fear out of, the average borrower when they can really understand, hey, here's the rate, but here's the reason why this affects it in this way.
Sure. And these aren't the only things that affect rate. There's lots of other little things that can affect rate. These are the main ones. So a lot of people say, Joe, how can I get the best rate on my home? Well, number one, work on your credit. If your credit score is low, get your credit score up.
Yeah.
There's a lot of things you can do. There's a lot of information out there to get your credit score up. Save for a larger down payment, but sometimes saving for a larger down payment might be counterproductive to actually getting in the home and saving money over time by getting in at a lower price. So the down payment may have an impact, but it's not going to be as great as the credit score. Loan term, maybe I want to get that thing paid off in 15 years and have a slightly lower interest rate, right? I might be able to buy less home, but that'll help me get my cost of money down versus otherwise. Debt to income has a minor impact, but still an impact. If your bills are paid off, your credit score is going to be get better, and you're going to get a better deal on the loan. Property type. If you're looking for a condo versus a home, that's going to affect the rate. So all in all, these 5 factors are the biggest factors involved in your interest rate. There are others, like if you want to pay your own taxes and insurance, there's going to be a rate hit. There's a little other nuances like that. Yeah. But these are the ones to concentrate on.
Yeah, definitely. And they all, in a way, well, not in a way, they all protect the borrower as well,
Right. And your propensity for failure, you're setting yourself up for failure.
Yeah.
Right. Some people say, well, they should be able to make those own decisions. Yes, but those decisions that the consumer makes impacts everyone else if they default. Right.
That's true. Yeah.
If you default on your house and it has to be foreclosed upon, then the values in your neighborhood go down. It affects everyone around you. So it is meant to protect the consumer, but it's also meant to protect not just that consumer, but the whole.
Yeah, that's good. Good stuff, Joe. This has been awesome.
Good. Well, thanks for helping me out today, Jake.
Of course.
Look, if you know anyone who might benefit from this information, please share it with them. Like, subscribe to hear the podcast on a regular incoming basis. We'll come right to you.
Yes.
If you just subscribe to it, boom, comes right to you. Thanks again, Jake, and we'll see you next time.